The furniture market right now is, well, frankly, it's pretty choppy. Housing trends are all over the place, consumer sentiment keeps fluctuating, and the broader industry has definitely seen a noticeable decline recently. But in the middle of all this, an iconic American brand, LZB, isn't just surviving, they are actually aggressively reshaping their entire business model. Today, we're unpacking their massive operational transformation and looking at exactly how they're driving their own momentum in a really tough market. All right, so here's our roadmap for this explainer. We're going to look at their fiscal year 2026 snapshot, break down their Century Vision strategy, and cover their retail expansion. From there, we'll look at some hurdles with their Joybird brand, dive into their huge supply chain overhaul, and finally wrap up with their financial outlook and returns. Let's get right into it. Section 1. The FY 2026 Financial Snapshot, a Foundation of Resilience. So, like I mentioned, the broader home furnishings market has been seeing this low to mid-single-digit decline lately. But LZB, they've found some seriously solid footing. We're talking $2.13 billion in consolidated delivered sales for fiscal year 2026. In an environment where a lot of competitors are actually shrinking, LZB is holding the line and eking out gains where others are losing ground. And you can really see that top-line stability trickling right down the income statement. Revenue ticked up a modest 0.8% year over year, sure, but look at net income. That jumped 2.4% to nearly $102 million. And diluted earnings per share up even faster at 5.1%. So they aren't just moving furniture. They are running a highly efficient operation, squeezing way more bottom-line value out of every single dollar that comes through the door. But if we peel back the layers on that revenue, it's kind of a tale of two different businesses. On one hand, LZB's company-owned retail segment delivered a seriously strong 6% year-over-year growth. But then you look at their wholesale segment, and it's just flat, zero growth. This perfectly illustrates exactly why LZB is shifting gears strategically. Basically, they're seeing that when they own the store, they win. Moving to Section 2, the Century Vision Strategy, preparing for a 2027 centennial. Okay, so LZB is coming up on a massive milestone. Their 100th anniversary is in 2027. And to get ready for it, leadership mapped out this comprehensive Century Vision. The goals here are pretty aggressive, honestly. We're talking about growing sales and market share at twice the industry rate and permanently bumping up operating margins into the double digits. To pull this off, they're leaning hard into direct-to-consumer reach, fixing up Joybird, and building an incredibly agile supply chain. Which brings us to Section 3. Retail expansion and acquisitions, taking control of the consumer experience. Now, because retail obviously brings in a much higher gross margin than their wholesale business, they want absolute end-to-end control of the consumer journey. Just look at fiscal year 26. They opened a record 15 net new company-owned stores, and on top of that, scooped up a 15-store independent network down in the Southeast. Because of moves like this, company-owned stores now make up a strategic 61% of their whole network. And they aren't stopping there. They are actively pushing toward a target of 450 total locations. Section 4. Navigating Joybird challenges, addressing volatility and direct-to-consumer. Look, it hasn't been entirely smooth sailing. Their direct-to-consumer brand, Joybird, hit a bit of a wall in the fourth quarter. They saw a 10% drop in delivered sales, which actually triggered a $20 million non-cash goodwill impairment charge. CEO Melinda Whittington came right out and noted that Joybird's core consumer has been, well, particularly volatile in this economy, but leadership isn't hitting the panic button. They're keeping a totally realistic perspective on the headwinds while still committing to disciplined investments in the brand. So what's the game plan to turn that ship around? It's a very clear three-step pivot. First up, they're carefully continuing physical expansion by opening 3 to 4 dedicated Joybird stores this coming year, mainly because those tend to be immediately profitable. Second, they're rolling out some targeted wholesale partnerships to expand their reach. And third, this is a big one. They're doing the hard operational work to consolidate Joybird's manufacturing right into their core U.S. plants to improve agility. All right, Section 5, Supply Chain Network Overhaul, the engine of margin expansion. If you really want to know how LZB is going to hit those double-digit operating margins by 2027, this is it. This is the engine. They are completely transitioning away from an old legacy system of 15 scattered distribution centers and moving down to just 3 massive centralized superhomes. This is a huge shift. It slashes their supply chain square footage by 30% and cuts the actual transit mileage for heavy furniture by 20%. Less driving means faster deliveries and some serious operational savings.
Of course, rewiring your entire logistics network while simultaneously running a $2 billion business, yeah, that's not free. It creates what they call friction costs, basically short-term headaches and expenses, like moving inventory around or overhauling software. But La-Z-Boy is intentionally absorbing that short-term pain today. Why? Because by year 4 of this project, they expect to gain a permanent 50 to 75 basis point benefit to their margins. It's short-term pain for long-term gain.
And we absolutely can't talk about their supply chain without highlighting their massive domestic advantage. 90% of La-Z-Boy's upholstered products are manufactured right here in the US. Because they are vertically integrated, they can crank out custom furniture deliveries in as little as 4 to 6 weeks. Plus, it essentially insulates them from all the geopolitical drama and tariffs that are keeping their competitors up at night. Oh, and to stay agile, they're actively streamlining operations by consolidating their 2 smallest upholstery plants into the broader network this year.
Finally, Section 6, Outlook and Shareholder Returns, rewarding shareholders while investing.
So, with all this money flying around for new stores, massive supply chain overhauls, and brand fixes, you might be wondering, how on earth are they paying for all this? Well, La-Z-Boy ended the year sitting on over $300 million in cash, and get this, 0 externally funded debt. Because their balance sheet is so pristine, the board just greenlit a massive brand new $300 million share repurchase program that represents roughly 20% of their outstanding shares. It's an incredible vote of confidence from leadership.
And this just perfectly highlights their strict financial discipline. I mean, they have paid consecutive dividends for 39 years straight. For the last 5 years, they've bumped up that quarterly dividend by 10% annually like clockwork. With the dividend yield sitting at around 2.87% right now, they've engineered a machine that successfully funds its own internal growth while still reliably throwing cash back to the shareholders.
Looking ahead to the immediate future, their guidance is measured but definitely confident. They're projecting Q1 sales to land somewhere between $490 and $510 million, keeping in mind that Q1 is historically their lowest volume quarter anyway. For the full year, they expect to spend $90 to $110 million in capital expenditures to keep fueling that Century Vision strategy. They are sticking rigidly to a capital allocation target of 50% for business investment and 50% return to shareholders.
Which leaves us with a pretty provocative question to end on. As La-Z-Boy eats these short-term friction costs to totally centralize its supply chain and expand its retail footprint, is this massive operational overhaul actually going to drive them to those promised double-digit margins by their 2027 centennial? They're clearly doing the hard structural work today, so they're ready for whatever the market throws at them tomorrow. It's going to be a really fascinating journey to track. Thanks for hanging out with me for this explainer, and I'll catch you in the next one.